We didn't have the best end to the week where pretty much every single company in the S&P was down and fairly significantly. We noted Alphabet down 5%, Meta Platforms down 4%, and if we just zoom out to over the last 30 days, again the conclusion is the same. It's just not been the best period for the S&P in the recent times. And you could argue, depending on what your holdings are, that year to date 2025 the conclusion remains to be the same. It's not been one of the best starts to an investing period, and perhaps especially if you are a newer investor. But having said that, Warren Buffett and those that do hold Berkshire, unlike the S&P, which is down year to date, they are up more than 16%. And what makes this even more fascinating is that Berkshire Hathaway's cash pile is now at a record high. We're talking nearly 350 billion. While the markets are dropping, there is fear right across the board, and maybe we will start to see them buy some shares that they do believe are becoming undervalued. Yet, whilst Berkshire Hathaway is up 16%, we have the AI giant Nvidia down 18%. Again, we can see semis as a whole haven't been that great. Broadcom, in fact, down nearly 30%. They've lost nearly 1/3 of their total market cap, and we're just talking about the last 3 months. And one of the biggest drawdowns in the S&P, and most definitely in the Mag 7, is Tesla, which is down 35%. Now, Tom Lee is very well respected in the investing community, constantly on CNBC with a lot of views which do typically tend to be fairly bullish, and he did nail his 2024 performance and his 2025. Bear in mind, this was at the end of last year. He saw the S&P heading towards 7,000 points by summer, but overall ending the year at 6,600 points, which, as we can see from the graphical perspective, is showing that we are anticipating a strong half to 2025 with a drop towards the end of the year. Now, perhaps this is something, given where we're sitting right now, is one you'd snap his hand off for it to be true. And we say this because at the moment we're sitting at 5,581 points, which is effectively more than 5% down on the year, which isn't really what Tom Lee was anticipating. But again, these are just purely analysts and no one does have a crystal ball. In fact, the S&P did drop around $1 trillion, and that is just a small 2% in market cap at the end of the week. Whether or not we see the continuation of this into next week with further volatility expected are things to consider, and we're going to discuss some of the pointers from last week that did ultimately scare investors even more. Now, one thing that he has been saying, as we said, he is fairly bullish for 2025, is that he is a buyer of stocks, and this was released at the beginning of the month, and the way he sees it is that a lot of bad news has already been priced into the market, and we're not just talking about the tariffs, which is a more recent conversation, but also, if you remember, the DeepSeek AI issues that we had earlier on. He does also believe a lot of this sell-off that we are seeing on a day-to-day is a massive overreaction, and that the markets, in his own words, are so oversold and pessimistic that a sizable rally is near. In fact, he goes on to say the odds of a 10 best day are coming, and they are extremely high, and this is why you could argue it's always important to be invested in the market. Don't try and time the market, it's all about time in the market. Because when we look at the 10 best days, if we go as far back as to 2008, the Great Recession, during that period, in fact, we did note some of the best days where the markets were up 12% on October 13th, 11% on October 28th, and in fact, we can also see a few more days in 2008 where there were some very strong performances, and that is his message right now. Markets are very oversold. In fact, in his latest article, he goes on to say that stocks have been rallying for 2 weeks, and while the strength may be difficult for many investors to reconcile amid the prevailing skepticism, we believe equities bottomed on March 13th following a 10% drawdown. Now, let me just show you, in the grand scheme of things, you may think 10%, that is very large, that is very scary, but when you do zoom out, in fact, you can see the market does always tend to move higher. However, one thing to note, this was the fastest market drop in a correction we saw since the 2020 crash, and could be a further reason to believe markets are oversold. There was a lot of panic, and now we may see the continuation of the upward trend that we have noted since the markets were open. And if we just go back to that, he also continues saying that many market participants remain cautious ahead of April 2nd, which marks Tariff Liberation Day, yet we view current market action as a repeat of the setup from 2018 during the first wave of tariffs under Trump's administration, and in 2018, equities also bottomed on February 19th 19th after a sharp 12% drop that was triggered by President Trump's comments on tariffs at Davos on January 26. And we can see this here, effectively Trump 1.0 in his first presidential term. There was a lot of talks about tariffs, and we did see just a few months later the market bottom before a very strong run leading up to that massive COVID drop. So he now believes there will be a face-ripping stock market rally, and he's already starting to say we may have seen some signs of this, and a V-shaped rally in particular from Tesla is what he believes will give momentum to the S&P and take it significantly higher. And we can see from Tom Lee's fund strat that he anticipates it has bottomed March 14th, and we could be seeing a $488 price target for Tesla in the not too distant future, which, as we said, he does believe will lift the S&P even higher. Having said all of this bullish news from Tom Lee, the market is telling him right now, as we see it in extreme fear, that they are very worried about the shorter term implications of tariffs, as well as other global economic factors, the rise in trade wars that could be seen, and therefore momentum is very low and investors are scared. Now, we like to look at this as an opportunity when we look at the market and their forward valuations. Even with the 10% correction we did note in March, there are still companies that we see trading overvalued, some that we don't get excited about unless we note at least another 10% drop, and we're still talking about companies in the Mag 7. Apple trading at a forward valuation around 27 doesn't really get us excited with the lack of growth we do believe they have, but there are some others on the flip side that we actually are starting to think could give an incredible opportunity to many investors. And some of those names that we do cover on the channel include Alphabet, where the forward valuation is sitting around the 16 mark. We have Meta Platforms around 20, and there are also other companies, but these are some of the most mispriced companies in the market, especially in relation to Google. Now, just last week we heard news of new auto tariffs from Donald Trump, and one thing to bear in mind, whilst he is putting a 25% tariff not just on imported vehicles but also key auto parts, it is going to drive up the price of cars by thousands of dollars. And one thing we need to remember with this, it will also have an implication on inflation, which will also have an implication on the market. Now, you might think these tariffs aren't going to really affect you, especially if you're someone who already owns a car or you aren't looking to buy one in the foreseeable future, but that isn't correct. As we just said, the tariff also applies to car parts, and therefore pretty much every single person who does have a car will ultimately be affected. And he's also come out to say that he couldn't care less if car makers start to increase their prices to offset the tariffs that are going to essentially make manufacturing their cars more expensive. They're going to be putting all of that cost onto the consumer, and as we said, it does look like the person that will suffer out of all of this are the consumers. He's also gone on to threaten a far larger tariff if the EU and Canada unite to do what he says as economic harm to the US, and this is what we are saying. Could we be at the start of a very large global trade war, or do we anticipate things are going to start to cool down? Retaliation isn't going to be as severe as maybe some people are saying, but one thing for certain, the market does not like all of this uncertainty. We also saw last week core inflation in February hitting 2.8%. That is also higher than expected and not near the 2% that they do have as a target. So again, we have to understand the ramifications of this, but for the time being, the market is pricing in 2 more rate cuts in 2025, but these things constantly change and it could be a lot more cuts, or in fact it could go to 0 very quickly. And we also have to remember that earlier this month Donald Trump did say a transition period for the overall economy is likely, and you can't really watch the stock market, and ultimately there could be some short-term pain for the economy and the markets before it gets any better. And remember his words at the beginning of the month, he's not even looking at the stock market, whether it goes up, whether we get a correction, which we did notice, and his bottom line on all of this with regards to tariffs is that he sees this as making the United States very strong and will continue with this, and in fact increase tariffs if needed, something we did see him do earlier on. Now, we also want to remind you, whilst it is good to look at historical data, it doesn't always become factual. In fact, when we look at the S&P 500 on a month-by-month performance over the last 100 years, February has typically been the second worst performing month, with September being in fact the worst, with around an average 1% drawdown. But noticeably here, March, which we have just finished, has been on average up around 0.6%, not something that we noted, and we are moving into April, which is historically the second most bullish month just behind July. Whether or not that does happen, it does remain to be seen, But what we do find quite interesting is that March, which isn't typically a poor month, has turned out to just be that, because as we saw, many companies were down quite significantly. Now we just want to run through 3 companies very quickly that Tom Lee does see, in addition to others in the same sector, that are going to perform very well after April 2nd. He does believe they will have a very strong rebound, including Tesla that we covered earlier. But he also believes Nvidia is going to be one of those. Whilst up 21% over the last year and up more than 20,000% over the last 10, massively outperforming the S&P, year to date it has been absolutely hammered down nearly 20%. They've essentially lost 1/5 of their market cap just in the last 3 months. But we can note it is trading now towards the lower end of the 52-week range. Wall Street continue to be very bullish with their strong buy rating. Seeking Alpha also consider this company to be a buy, and we note their forward PE now sits at 24, which as we can see is significantly lower than the 5-year average of 42.9. That makes it severely undervalued, and we can also point out that when we look at it in terms of the last 5 years, the company's trading right now significantly lower than the blue tunnel, which does encapsulate the expected fair price. In fact, even lower than the bottom end, there is a significant amount of disparity, meaning that Nvidia does look to be severely undervalued. And typically we do deep dives on this channel. We run through the companies. When we have done our discounted cash flow model, it comes to $162, and we've effectively used a growth rate of 20% moving forwards. Bear in mind the 5-year and the 10-year has been triple digits. Just over the last 5 years, in fact, they've grown their free cash flow 153% year on year. And when we do use the 20% and the discount rate, we then get the present value of the future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. And as you can see, 162 is where we do believe this company is at, and that indicates 49% upside. Again, you could be someone that believes 15% is more appropriate, and we'll show you for transparency. That brings it to 115, near the current price, meaning right now Nvidia already baked into the numbers is near a 15% MOS, and for those that are a lot more bullish, at 25%, 227 indicating 108% upside. That is more than a double from the current trading value. Now when we do our deep dives, we do typically take through the medium rate where we're not just done, because we add a margin of safety where we use 10%. We execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data, meaning it would be a buy at $146. Then we'd keep going till it's near the current trading price, and effectively what we're saying right now, Nvidia, not a 35% MOS just yet, but you're getting at least 30% up to $114. Wall Street see this at 177 over the next year, translating to a whopping 63% upside, one that Tom Lee does believe is a strong buy and actually has bottomed just recently. Again, other companies he does believe will be very strong, similar to Nvidia, is Microsoft, which is down 10% over the last year. Year to date, also down 10%, but over the last 10, it has still outperformed the S&P at 840%, trading at its 52-week low, with a strong buy from Wall Street, a buy from Seeking Alpha, and a forward PE sitting around the 28 to 29 point, which as we can see is also significantly lower than their 5-year average of 31.7. Again, these are companies that have been hammered fairly recently, and similar to Nvidia, whilst the disparity isn't as much, it is just outside the blue tunnel. Again, severe undervaluation. So when we do run it through our model, our intrinsic value comes to $488, where we have used a 16% growth rate moving forwards. Now we'll show you the margin of safety that is implied here. So at 10%, a buy at 439, at 20 around 390, at 25 not there yet. So right now for Microsoft we see 20 to 25%. Wall Street again, very strong buy rating, $508 is envisioned over the next year, translating to 35% upside. For those that do believe that is too high, want to use more in line with the average at 14%, you also get a margin of safety at 10%, pretty much around the level it sits. At 15%, 360, so not quite there yet. So even at the lower end for Microsoft, you are getting a 10% MOS, and as we said, Wall Street fairly bullish, 35% upside. And one that we believe to be incredibly undervalued. We've done a very deep dive just over the last few days, so do check that out. But it was down 5% on Friday, only up 2% over the last year. Year to date, down nearly 20%. but over the last 10, again, still outperformance of the S&P, up 470%, trading near its 52-week low, a double buy rating from seeking out from Wall Street, and a forward P sitting around the 17 mark. Again, significantly lower than the 5-year average at 22.3, and also on this model, we do get disparity between the lower end and where it sits, so severe undervaluations all across the board, and our intrinsic price at $226 is using a 12% growth rate moving forwards, which when we do come to look at the margin of safety, again is very significant. And remember, Tom Lee does believe the markets did bottom this month. You're getting at least 30% up to $158. Wall Street see this at $220 over the next year, translating to 43% upside. Again, we can show you for those that believe that is way too high. At 10%, 197, you're still getting a fairly respectable MOS, which as you can see at 10%, a buy at 177, at 20%, pretty much where it does sit or nearabouts, 20% MOS and 43% upside. As always though, give us your thoughts. Do you believe some of these stocks are good buys in the markets at the moment? Are you maybe holding on to cash? You do see this going even further, or any other opinion overall? Don't forget as well to sign up to our free weekly newsletter. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below and you can sign up, read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of March. Lots of information for each one, including the upside that Wall Street themselves see, and we will be releasing April's copy in the next few days. And on top of that, you can grab a recently released copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. And in tomorrow's article, we will also be giving out a free spreadsheet running through all the dividend kings, lots of information for each one, many points, the undervaluation, the expected upside, and the expected downside. So make sure you are signed up by clicking on the link below. As always, have a great day, and we'll see you all on the next one.